Hi and welcome to Yahoo Personal Finance. I'm Alex Brophy and joining me today is Financial Spectrum's Brenton Tong to talk about when to take profits. Brenton, thanks for joining us.
Thanks for having me, Alex.
We've had a great run up in shares throughout the second half of last year and well into 2013. Market's up almost 50% since its lows. Is it a good time to take profits now?
Well, it really comes down to what your overall strategy actually is at the moment. So any profit is a good profit. And it really comes down to, I guess, the expectations that you're setting when you first got into the market.
Right.
So if you're investing today, if you invested several months ago, if you invested 6 months ago when the market was a fair bit lower than where it is at the moment, it's really what you're intending to do when you got into the market, which will dictate what you're actually doing when you're getting out. Mm-hmm. If you got into the market with an eye that the yield story was particularly good, that the stocks were undervalued, and you're looking to actually make a profit in a reasonably fast turnaround, then it's about working out just the level of profit that you need to satisfy the risk that you've taken to get into the market. If you got in earlier when the stock price was significantly lower, eyeing off the fact that, yes, it's particularly good value, but you're in it for the long term and you want to collect those dividends and you want to see year on returns from a capital growth point of view, then while the market's in a good position now, a lot of people still feel that it's still got a little bit further to go. But if you take that 5 to 10 year time frame, then the market potentially has significantly further to go, obviously depending on economic circumstances.
So in making that decision, should you be removing yourself from the current market position and just going on those fundamental reasons?
Well, when you're looking at a strategy for investment, then that's probably quite a good idea. Otherwise, it's quite easy to get caught up. And quite often I do see a lot of investors who you see a little bit of profit, it's there, you think there can be a little bit more, and all of a sudden you're starting to eye things which are probably not ideal for your circumstances. If, however, you were after a short-term gain, then again, it's just about assessing what level of return you need to satisfy the risk that you're actually taking. And for some people today, it could be just right. And for some people, they probably want to hang on just that little bit longer.
Okay, so how important is it to set firm rules before getting into the market for your profit strategy?
It is vital to actually set some rules, especially if you're looking at a shorter term strategy. It is really not that different to attending a property auction when you work out exactly how much you want to be spending on that property. You should hit that limit and really you don't want to go too much further. The problem with stock trading, when you see some profit, it is so tempting just to go that little bit further and that little bit further.
Sure.
And it is inevitable that if you were to sell out and take a profit, if you watch the stock price, on the balance of averages, you're going to see potentially a little bit more on that. And it's always going to be a little upsetting to a certain extent that you could have just had that little bit more. But what you really need to do is, of course, just be satisfied the fact that you've had a large check just deposited into your bank account, bank the profit, move on, look for your next transaction.
Right. And on the flip side, in terms of taking losses, is it a similar procedure there?
Well, losses, a lot of research is done into the psychology of losses, and that a win is nowhere near as satisfying as what a loss is dissatisfying to somebody. So what I see with a lot of investors and traders is that when you do take a little bit of a loss, it does hit you a lot more than a gain. So 20% up, you're going to feel good, but 20% down, you're going to feel even worse. Right. And it is very, very tempting for a lot of people to start to look at the buy-in price. And there's a context which I talk to a lot of people with regards to what they pay for a particular asset, and whether it be shares or property or bonds or anything at all, is what you paid for it is historical. It has no bearing on its value today. Mm-hmm. So you have to be very, very mindful that when you're looking at an asset, any asset, but specifically stocks at the moment, you have to look at its value today. The fact that you bought it for $1 and it's currently sitting at 60 cents, the dollar has no bearing whatsoever on its value today. And you have to ask yourself, if you were to see that stock today at 60 cents, would you buy it thinking it's good value? And so many times I've actually asked people, would you buy that stock at 60 cents? They go, oh, no way, it's a shocking company, yet they're still willing to hang on there and hope that it hits $1 again.
Right.
So quite often the historical buy price really starts to put a lot of your decision making into a bit of a blurry field. So you should really set some very, very careful rules before you get in to make sure you can just keep your eye on exactly what it is you're trying to achieve.
Sure. Some great advice there, Brenton. Thanks for your time.
Thanks for having me.
See you next time with Yahoo Personal Finance.